This is Richard Flax at MoneyFarm with our regular monthly update, recorded on July 27th. This month we've seen geopolitical risk back in the forefront, as the conflict in the Middle East has heated up again. The oil price has risen back up towards $100 a barrel, again raising concerns about the outlook for inflation in the coming months. In terms of market performance, global equities and global bonds have performed roughly in line, down around 1% for the month through July 24th. Commodities have been the relative winner over the course of the month, driven by the jump in oil prices. Within equities, there's been quite a spread in performance. UK equities have held up pretty well, up around 2% month to date. Tech names were the relative losers, with the Nasdaq and emerging market equities giving back some of their strong performance from earlier in the year. We've also seen the usual round of earnings reports for the second quarter, particularly in the US. Expectations were high going into the quarter, and the results so far have been pretty solid. So far, around 27% of the S&P 500 have reported, with year-on-year earnings growth coming in at close to 38%. There are still a lot of company results to come, but that's an extremely strong number, the fastest growth since the third quarter of 2021, when the economy was rebounding from COVID. Energy and technology companies have led the way in terms of earnings growth, reflecting the twin themes of higher oil prices and really strong demand from AI. But recently we've seen more concern around just how much so-called hyperscalers are spending on their AI build-out. We saw that play out in the earnings report for Alphabet recently. While the long-term potential for AI should be significant, it's tougher to know exactly when we'll see that materialize in a sustained improvement in corporate earnings, not just in the tech sector, but in the broader economy overall. Corporate executives will at some point need to see a benefit from all the AI projects that they're doing. For now, we think that investors will give companies the benefit of the doubt. But we're all looking for signs that AI adoption is really improving earnings growth and corporate profitability across equity markets. Fixed income. We've seen government bond yields rise in recent weeks. Investors are concerned that higher oil prices will feed into higher inflation in the coming months. Central banks face a familiar question: how to handle a supply problem, i.e. higher oil prices, when the tools you have, interest rates, are really only effective at dealing with demand. The ECB has already highlighted the challenge, raising rates a few weeks ago, but leaving their policy rate unchanged at the latest meeting. For now, we think that central bankers in the US and the UK won't raise rates, but they'll be watching the inflation dynamics pretty closely over the coming months. Of course, oil prices aren't the only challenge for fixed income investors in the UK. Andy Burnham is now the Prime Minister, and investors will be looking to see how fiscal policy will shift. Burnham and his new Chancellor, John Healey, have said they'll abide by the current fiscal rules. But the Prime Minister will be looking to spend more where he can, and that probably means higher taxes in the autumn. At the same time, it's widely understood that the UK faces a growth problem, and higher taxes in the short term are unlikely to improve that picture. But the investment picture remains complicated. As we've seen, the current earnings environment is really good, and companies look pretty healthy. The geopolitical picture remains tricky, and that could create some challenges for policymakers. But we continue to think that the combination of strong earnings growth and high starting bond yields should provide a decent backdrop for long-term returns. Thank you for watching, and look forward to speaking to you again soon.